Hi, and welcome to the 50 or Nothing community. For about 1 month ago, one of my subscribers recommended me a stock to look at called Aumann AG, ticker symbol AAG. The stock was trading for around 20 euros 6 months ago, and the stock has declined more than 50% down to 11 euros. What caught my attention to the stock that it was trading at a really high net cash position. So the stock currently trades at 155 euro million, whereas the net cash sits at 113 euro million. So just to put this in perspective, you're getting 8.3 euros in net cash per share, whereas the stock trades at 11 euros. That difference between the net cash per share and the stock price is around 3 euros. And that needs to come from the core business. Once that comes in, then you as an investor will break even. Going forward from that, that will just be a surplus for you. That will be money in the bank. And I haven't seen that high net cash position for a company that doesn't lose money. I have seen companies trade below cash in China and Asia, but that's a totally different corporate governance risk, you would say. But this stock is a European company. So in this video, I'm going to talk you through why has the stock declined more than 50%? Why have they announced share buybacks? And finally, what I believe you're watching this video is, should we invest in the stock? Is this a cheap stock and can we make money out of investing here? But before we proceed, if you like this uh, investing content, please hit the like button and subscribe so you don't miss out on any undervalued stock opportunities. Well, as always, I have an investment checklist, which I will gauge before I decide on buying or not buying the stock. The first one is having an aligned management, meaning we have someone with skin in the game. We don't want to have a company with passive owners, because what happens then is that management in the company will then take the decisions. And of course, management will not have the shareholders' value as a priority, rather their own. Then, of course, we need to have a compelling valuation, meaning that the stock trades below intrinsic value. And then, of course, we want to have obvious growth potential for the company, that we can see that it will grow in the future to come. And we don't want to have any blow up risk. And what I mean with that is there could be several types of blow up risk. One, which is the obvious, that company has a high debt burden. We look at the balance sheet and see that they can service their debt. Number two, I don't want to see that the company has, for example, a high customer risk. There, for instance, we have a customer that stands for more than 90% of the company's revenue stream. What happens if the company loses that customer? So that's a type of different risk that we're going to also take a look at. And finally, does the company create value to shareholders? And that's a really simple check that we could do by looking at investment on return on invested capital, and we could compare that against their cost of capital. And of course, we want to have a high return on invested capital in comparison to the cost of capital. And finally, before now I proceed, we're going to do two things here. We're going to do a discounted cash flow to determine if the stock is undervalued. And then finally, we're going to do a pricing comparison. So what we're going to do there is we're going to look at competing firms within the same industry and see what price the market has given them. And then we're going to compare that to our business. So with no further ado, the reason why the stock has declined more than 50% can be found in the financial statements. We can see here that in the 2023 order backlog, they had around 308 euro million, whereas now in 2024, the order backlog declined more than 27%, which I believe is really heavy, right? And now what the markets anticipate is, of course, that the order backlog will hit the revenue in 2025. And the business model of the company. Aumann AG specializes in automated production lines and machinery, focusing on two segments, the e-mobility, which is, of course, the electric cars, and then you have the classic cars. But I saw there that around 80% of the revenue is derived from the electric cars, whereas the traditional cars, the ones that are gasoline driven, diesel driven, stands for around 20 to 30%. And that is a positive sign because I believe the future will be the electric cars. And reading through their financial statements, I also saw that they had a risk. And they mention, if I recite them, is that trade barriers that might impede access to Aumann's market. And of course, we all know that Trump, once he was inaugurated as a president, he announced that he will impose tariffs both on China and Europe as well. We don't know the specificities of these tariffs, but we know that somewhere around April, we'll have a more clearer picture. But that is the risk that we need to bear in mind because I remember as soon as Trump announced the trade tariffs, all of the automotive stocks were just crashing. Not crashing, but they were declining by 5 to 6%. And now going to look at the ownership of the company. Remember, I was talking about my investment checklist. I want to have the aligned management. And here we can see there is an investment firm called MBBSC, which owns around 50% of Aumann AG, which is quite a big stake, I would say. And in accounting rules, if you own more than 50%, then it classifies as a subsidiary. And then if we even trace back and see who owns this investment company called MBBSC, it's owned by founders whose name is Christopher Nesemier and Gert Maria. They own around 71% of the company. And remember, I said that I want to have an aligned management. And here I could say, without knowing those persons, behind that company, that we have someone with flesh and blood that owns this company, Aumann AG, through this conglomerate called MBBSC. And as I mentioned, this company has a really high net cash position. So we could see that they've announced share buybacks given their high net cash position. And they wrote that until June 2026, subject to compliance with the principle of equal treatment, up to an amount of 10% of the share capital at the time of this authorization. The authorization may not be used for the purpose of trading in treasury shares. Here what it's saying is they're going to buy back shares. And it's a signal for us as investors and the market. Whenever a company announces buybacks, it could be that they don't have any investment opportunity currently, that they could take that cash, invest that, and earn a higher rate than their cost of capital. If that opportunity is not there, what they will do is, hey, you know what, let's take that cash and give it back to shareholders. And that is what I want to see here. And given that the order backlog declined by 27%, that's a good sign. I want to have that cash back. And that is also, again, what I'm repeating myself here. We want to have an aligned management because that aligned management now wants what's best for the shareholders. So that's a good sign. We went through the shareholders and ownership structure. Now what we're going to look at is valuing this company. And we're going to do this in two ways, as I said, pricing and free cash flow. Now, if we just take a look at the company in my screener, this is my stock screener here. I'm just going to collect the data from, I use a website called Coinfin. This is where I get all of my data for all of my stocks. And here I'll put Aumann AG's data. Just going to run the macro to just make the data that I pasted more compatible with my Excel sheet. And here I'll put Aumann AG, right? And here is my stock screener. And what I use this for is just to, you know, what I do a proper due diligence. Whenever I find a stock, I will read all of the papers in the financial statement. Sometimes it could be 100 pages, but it's quite time consuming. So what I have built here is a stock screener. Whenever I look at stock, I just screen it real quick to see that is there anything of interest. And if the stock screener gives me all the checklists green, then yeah, I'll take it further and do a proper due diligence and read all the financial statements. But let us look at Aumann AG here for a sec. Here is the revenue. Let me zoom in so you could get a glimpse of the revenue. Before I go in to depth, I'll just tell you here that the blue line is the gross margin. Here, the yellow line is the operating margin, and of course, the staples here are the revenue. And 2020 was the COVID when it hit. And we could see that, the growth has rather been flat for this company. The 2015, they had a, revenue growth, a revenue of 93 million. And then it grew to 294 million in 2018. But then it started to decline even before COVID to 264 million. And then it still, declined for 3 more years. Whereas then in 2022, the company started to see growth. And also take a look at the operating margin. It also declined. There were money losing 2 years, 2020, 2021. And then they reverted back to profitability in 2023 and 2024. What this tells me is that this is a classic cyclical company. So now you're wondering, so what? Well, if it's a cyclical company, it means that we can't just take a look at the most recent profit margin, which in this case was 7.7% in 2024, and just, use that as a proxy and just, taking that 7.7% and just estimating the future years. Because then the risk is that we will overvalue this company, given it is a cyclical company. The profit margin might drop next year. And it didn't surprise me that there was a cyclical company because they work in the automotive industry, like Volkswagen. If you look at Volkswagen profitability, it will go like in cycles, cyclical. So for cyclical companies and commodity companies, for example, as oil companies, you can't just look at the current PE ratio and just say, oh, it's cheap. You need to estimate what will happen next year. What happens if the oil price declines? Same thing here for Aumann AG. And I'm going to show you a technique, what I do. I do what is called a normalized earnings. So I'm going to look back in the history, and then I'm going to normalize their current, their historical earnings and project that as the future. That is something that we will do. Also, I told you about the high net cash position that they have. Here you can see in this staple here we saw the cash of 133 million. And here you can see that the stock currently trades at 8.3 euro in net cash, which is really high. And that is what caught my attention, as I said before. But let's now go and value this company. I think we have the information that we need. And I'm going to do, because, looking at this company, I can say, you have different stages for a company. It could be a young company growing, at 20%, then the company matures, and then the company gets older. As us, as human beings, we are toddlers, we become younger and older and older and older. And the same thing applies to companies. So given that I see that Aumann AG is not a young company, it's a mature company. And in fact, it was founded 1938. So it's a really old company. Now, I don't expect this company to grow by 20% on an annual basis. I will use what is called the cash flow model, the Gordon growth model, in perpetuity. Meaning, I don't need to discount the future cash flows. I can take the cash flow as of today and value the company. But there's a caution. You could only do this for mature companies, as Aumann AG is. So let's me do right. I need the return on invested capital. And let me zoom here so you can see the table. I need reinvested capital, and I also need years, historical years, because remember, I want to normalize the earnings, given it's a cyclical company. These are the years. Then I want return on invested capital. Paste here. Percentage. And here I want the average. And I want 15 to 2.4. So I get an average of 60%. And here I want to have the EBIT margin. Again, I want to normalize because this is a cyclical company. Ball first. Here, coloring. And here we have EBIT margin, and I go back to here, my screener, I have the EBIT margin. Well, values, average, and I get 4%. And you see here we can see the cyclicality of the company. 10%, 11%, 2016, 9%. Then it drops down to 6%. That was even before COVID. Then 11%, 10%, 0. So remember, I can't use 2024 profit margin as a proxy. I'll need to average that out. Now, what we need to know, we need to know what the growth will be. We need to know my demand, what I demand as an investor, as a yield for this company. And given this is a German company, and in valuation, you need to be consistent. So if you use the currency of euro, then you need to use the risk-free rate of that currency. You can't mix and match, because then your valuation will blow up. And the reason is because we need to match the inflation. Now, given I'm valuing this company in euros, I need to look at the 10-year government bond in euros for Germany. And I believe there's a website in Sweden called Dagens Industri, which we could look at. Here, click here. And here we have the 10-year government bond, 2.38%. So put here 2.38%. And what I'm assuming here, again, this is a mature company. This will not grow by 20%. I will just say this will grow by 2.38% on an annual basis. What I'm demanding as an investor, I could go in and do, specifics, look at the beta, and the risk premium and see, their default risk to get us, an exact weighted cost of the weighted average cost of capital. But, in this video, let's just make it simple. Let's say I'm demanding 10%. Like this. This is 10%. Then I need to know reinvestment. The reason is I need to know how much, when the company grows, there's no growth for free. When a company grows, it needs to reinvest in its core business. And that is why I'm going now to show you a technique how you could do how to figure out how much they need to reinvest in order to grow that 2.38% that I just mentioned. So there's a formula called, and the formula goes like, if you want to know how much the company will grow, you want to estimate growth, you could take return on invested capital times reinvestment equals, like this, equals growth. If I want to know how much they need to reinvest, I could just solve for X. In this case, reinvestment. I could just take growth divided by ROIC. It will give me reinvestment. That's why I normalized return on invested capital. That is the reason why I took this. If I take now growth, which it will grow by the inflation, by the inflation rate in Germany, then I divide it by return on invested capital. I get 14.86%. So what this tells me is that the company needs to invest 14.86% of its operating margin in order to grow 2.38%. And look here, this formula is just fantastic, because if I would now increase the growth here from 2 to say 6%, what we will need to see is that the reinvestment will also need to increase. Because the reason is, in order to grow, you need to invest more. Let's see if that works. Let me put 5%. See here, it's consistent. It tells me you need to reinvest more. So that is the reason to why I normalize return on invested capital to get the reinvestment. Now, the revenue of the company, what was that? It was 325 million. €5 million, and decline in revenue. There was a decline in revenue. Remember, we said we saw the order backlog drop by 27%, and that will, of course, that will be seen in revenue. Let's put 27% here. Now we get an EBIT. Now I take 325. Now I take that minus the 27%. Then I get a revenue of 237 million. Now I need to remove the tax, because enough, to operate, you need to pay taxes. And in Germany, of course, we need to take the average weighted tax rate where the company operates. And the company operates in Germany, in China, and United States. But let's just keep it simple. Let's just say 30%. That's the marginal tax rate. By 30%. Sorry. This is revenues. This is taking the normalized operating margin like this. Number 8.34 euro million. And remember why I took the normalized earnings, because this is a cyclical company. Now I need to pay taxes. And let's keep it simple, say 30%. We get 5.84 euro million. Now we want to, I'm going to do a free cash flow. So I need to come down to the free cash flow. The free cash flow is EBIT after tax times what I need to reinvest, the 15%. So I'm going to have around 5 million in free cash flow. That is what I need to invest. And you're probably wondering, what is reinvestment? Reinvestment is the working capital. So you have like accounts receivables, accounts payables, you get stock, all of the assets which are short in nature. That is the working capital. Then we need to take capex, which is capital expenditure. For example, if this company invests in property, plant, or equipment, that will be classified as capital expenditure. And then we take that net the depreciation. All of those three will then be the reinvestment, and then we will arrive at the free cash flow. And remember, the free cash flow is also referred to as the unlevered cash flow, meaning this is pre-debt. And that is why I'm taking EBIT, because if I would take in net income, then I would have interest income in that computation, and that is coming from the cash flow from the financing cash flow. And remember, free cash flow is always pre-debt, and that's why we need to take the operating margin before that. Coming here, we have a free cash flow, right? And now we could value this company. I believe we have everything here. So let's enterprise value. I'm going to take, and I'm going to use the free cash flow in perpetuity. So I'm going to take free cash flow divided by what I'm demanding minus growth. So I'm getting 65 euro million in value, and stock is trading currently at current value of company. You have that compare. That's around how many shares did it? Let me do this later. We can check. So enterprise value. Again, I said to you, this is pre-debt. So I need to subtract the debt. And they had around, how much debt they had? They had 7.44 million in debt. So 7.44 debt. And again, we're not done yet. We need to add the cash. How much cash did the company have? They had around short-term balance. Total cash and short-term investment, 133.48 euro million. 48 euro million. But now there's one thing I'm going to treat as debt, which is pension liabilities. The union in Germany is really strong. And when a company has pension liabilities to employees, it needs to repay them. And I will treat that as debt. Let me see, balance sheet had pensions and provisions, 13.4 euro million. So let's put that here, 13.4 euro million. Now we could arrive to equity value. Do enterprise value minus debt minus pension liabilities, and if we add back the cash, I get an enterprise value of, equity value of 177 euro million. There's one thing more we need to do to arrive at value per share. How many shares do they have? Number of shares. If we go back, and I could see they have 143 euro million. But we have everything in millions here, so I need to divide that by million. 3, 4, 5, 6, 14.39 million shares. And now we get the value per share. If I take this divided by, I get 12.35 euros per share. Stock is trading currently at 10.8 euros per share. So we could have potential yield if I take this divided by the -1. I have around 14% in yield. And I told you this is what I see. If I do a free cash flow, I have around 14% in yield. That is what I see. Now let's do a quick pricing. If we go here, and how are you gonna? And just to say real quick here, pricing is you don't use the cash flow to arrive at a value. In pricing, it's like when you buy a house and you go to your real estate agent, they will look at comparable houses near your area and say that, hey, that house sold for, I don't know, 40,000 euros or kroners square meters. I believe you could get that. And that is exactly what we're going to do here. We're just going to compare what, comparable firms trade at currently. So, and how are you going to read this diagram here? This is statistics. That's why statistics is really important. So I pulled out 28 firms from Koifen, which is quite similar in their business model comparing to Aumann AG. And here on the left, you can see the metrics that I'm using. So min is, of course, minimum. So the company that had the lowest gross margin out of the 28 companies had a gross margin of 10.8%. The quartile 1 means between 0 and 25% of the 28 companies had 21.7% gross margin. The median means 0 to 50% of the 28 companies had a margin of 29.2. Quartile 3 means 0.75% of the 28 companies. Max is the company that had the highest gross margin, and the mean is the average. So we can see here that Aumann AG had a gross margin of 36.8%, higher than the median, which is good. In EBIT margin, we can see that it had higher than the median. Return on invested capital, higher than the median. Return on equity, higher than the median. This is really good. And if we look at the risk, I told you that the net cash in this company was really high. And of course, you can see that total debt to equity, the lower you score, the more cash you have. And you can see here that Aumann AG scored the highest. So if you have the lowest percentage means you have lower debt. So that was not surprising, but that's lower than the median. Now, if you look at the growth, we can see here that on the 5-year compounded annual growth rate, Aumann AG scored really low because the median company grew at 7.5%, whereas Aumann AG only grew at minus 0.1%. However, during the 2 years, it scored higher than the median. It grew by 34%, and the median was at 11. And then if we look at Aumann AG the past year, it grew by 21%, whereas the median grew by 1.9%. And that, I believe, when we look at the PE, that's why it's trading below the median. I believe it's because it grew the least of all of the companies when we look at the 5-year compounded annual growth rate. It grew only minus 0.1%. That is the reason now when I'm going to price the Aumann AG, I'm not going to pick the median value. I will pick even the quartile 1, which is a lower value. So let's see here. So net income for Aumann AG, that's at 1.23 euros. Let's put that there. And then the quartile 1 PE was 14. And we get an equity value of 17 euros. So if we do pricing, we're getting a higher value, 17 euros. If we do discounted cash flow, I'm only getting around 12.5 euro. So there you have it. You have now the two different models or techniques that I'm using, and I always use that before I determine if a stock is really cheap or not. Let me just give you one more thing before we end this session, because I got the question before. Now let me talk about this here. I had a member. He told me that when you do discounted cash flows, what you're not bearing in mind is a share buyback. And of course, my answer to him was, no, everything is included. Don't worry about it, because again, free cash flow is pre-debt. It's where you get the revenue streams, the core streams from the business. Now, when you do share buyback, you either get your money from free cash flow, meaning from the business, and if you don't get, if you don't have any money from the business, say you have zero, how are you going to do share buyback? You don't have any money, right? The only way you could then do share buyback is go to the bank and say, lend me 100 euro million, and I will take that money and then I will do a buyback. But then that will eliminate, because if you look at the balance sheet, you're increasing 100 euro million, right? And then in the asset side, you have cash 100 euro million. The debt 100 million, cash 100 million becomes zero. So what I'm trying to say here is, when I do free cash flow, everything is included. I'm not missing out on anything. Let me just show you here as an example. Share buyback. All right. They go to the bank. Right here, I have enterprise value. This is prior debt. This is free cash flow. I go to the bank. I say, give me, let me put this here. Give me 100 euro million. Then it sits 100 euro million in cash, right? I get 100 million from the bank, but I need to repay that to the bank. I get 100 million from the cash. What happens? 100. I have the 100 in cash. I need to repay that to the bank. Zero. It won't affect my value, because the value needs to come from the core business. That's how we're going to do share buyback. So that was the only final thing. Now, you're probably wondering who I am. And I could just say that I have a long banking experience. My main when I worked at the bank, I was lending money to all private businesses to more the bigger public quoted companies. I have more than 15 years experience in the banking industry, and the main task was to read cash flow statements, look at the business risks in order to check the repayment capacity. What I'm doing now is I'm using that to value companies. And I hope you find this session rewarding and that you learn something. And that is the intent of this video. And I just want to tell you that hit the subscribe button so you don't miss out on any other videos that I'm going to publish. And also, in the link below, you're going to see I have a Patreon link. In that Patreon link, I share my entire portfolio to my members. All of the companies that I value, I publish there, and they could mimic my stock portfolio. And also, sometimes I'm like a mentor. So they'll ask me questions, I'll also reply them back. But hey, you could also write comments here in the YouTube video, and I'll also try to answer those as quick as possible. And I just want to say, in this Patreon, it's only 95 kroners each month, and there's no binding fee, so period fee. So you could cancel whenever you want. Thank you for listening, and I hope you found this session rewarding and that you learned something. And see you next time. Have a good day.